What if the fastest way to restore housing affordability is your home value dropping? Wild take, but that's the math right now. Debt to income near 39%, mortgage rates stubborn, sellers slashing list prices. This isn't theory, it's trend. In this countdown, we hit 10 Florida markets where the numbers say demand is cooling and concessions are climbing. One is projected to fall below a key price level by next year. Another is posting a slight projected increase that doesn't tell the whole story. You'll see the signals in order so you can spot the turn before your agent does. Before we continue, hit subscribe so you never miss the latest updates. Number 1, Punta Gorda. A market losing double digits in a year and lining up to crack a psychological floor. How does a boomtown turn bargain bin this fast? Punta Gorda is the case study nobody wanted. It's down roughly 12% year over year with a fresh 3-month slide. And the current trajectory puts the median dipping under $300,000 next year. That's not marketing fluff. That's what the math implies when momentum flips and stays flipped. Here's the setup. Pandemic money and people poured in. Builders revved. Investors grabbed pre-construction slots like concert tickets. Then supply kept arriving while buyers thinned out. Listings started stacking. Sellers didn't panic at first. They tested the top. The top didn't answer. Then came the trims. You see it in the behavior. More red arrows on listing histories. First cut is a polite 1 to 2%. Silence. Next cut is 3 to 5%. Still quiet. Days on market creeps from the low 20s into the 40s and beyond. Weekend open houses get light traffic, and Monday brings a motivated seller note. By week 6, the discount isn't just cosmetic. It's real money off the mortgage. Let's talk affordability math. Buyers are stretched. Rates are stubborn. That combo narrows who can even show up with a pre-approval that clears underwriting. Every extra quarter point on the mortgage rate eats a chunk of purchasing power, so the only lever left is price, and sellers are pulling it. Fewer offers, more concessions, closing credits, inspection repairs, and rate buydowns that shave the monthly but also telegraph weakness. It's like a theme park line that suddenly disappears. Fun for the next rider who strolls onto the coaster. Terrifying for the ride operator who knows empty switchbacks mean revenue just fell off a cliff. Cheap entry feels great until you realize why the line is gone. Now the data signals that matter here aren't subtle. Short-term price drops carry more weight because they capture the turn in real time. And Punta Gorda is flashing that right now. The share of listings with price cuts is elevated, and the average size of those cuts is expanding. That's an instability profile, not a seasonal wobble. Sub $300,000 won't read like a heroic rebound. It reads like capitulation. Sellers accept that the 2022 comp isn't coming back to rescue them. They price for a smaller buyer pool and hope to beat the next reduction wave. The equity drain looks orderly, but it isn't temporary noise. It's the correction doing the heavy lifting that rates alone couldn't. Number 2, Cape Coral. Cape Coral still looks glossy in the photos. Fresh paint, canal shots, palm trees flexing. But the real story hides in the price change tab. Scroll that history and you see a slow drip of reductions that don't show up in the main splashy headline. It's the quiet stuff that matters. During the pandemic, money flooded in. Prices ripped. Investors lined up for new builds and fast flips, convinced demand would stay infinite. Builders pushed permits, poured slabs, and the comps kept chasing the last high watermark. That script looked invincible until carrying costs got loud. Here's the catch. Insurance premiums jumped. Rebuild costs rose with materials and labor. Then rates pinned move-up buyers in their current homes. You can want a bigger place, but not at a payment that looks like a car lease stacked on a student loan. So listings linger, and sellers start blinking. Mid-teen dollar declines sound small until you see the monthly. A $13,000 shave on a mid-$300 house doesn't read like a crash, but paired with a lender credit or a point buydown, it chops the payment enough to nudge someone off the fence. That relief only shows up after the reduction, though. List high, wait, price cut, then action. It's backwards momentum dressed as patience. Watch the signals, more listings with cuts, and the average cut getting bigger. Classic cooling. You don't need 10 metrics when 2 are screaming. The behavior is the tell. First reduction to test interest, silence. Then a deeper trim to catch the next weekend's tours. Take a standard $450,000 house. Day 1, everyone feels bold. By day 30, the seller trims 5% to $427,500. Traffic improves, but no clean offers. By day 60, they shave again to around $418,500 and toss in $8,000 toward a 2-to-1 buy down or closing costs. Effective price? You're quietly in the low 400s on a deal that started near $450,000. That's not a fluke. That's the playbook. Short-term declines carry heavier weight because they reveal today's bargaining, not last quarter's comps. In Cape Coral, that recent 3-month slide, about $13,000 down into the mid-300s, signals sensitivity to every macro headwind. When the average dips like that in one quarter, the market's telling you it's reactive, not resilient. Inventory adds pressure. New construction that stalled midstream turns into spec homes with carrying costs. And some investors tap out when rent doesn't pencil against insurance and taxes. Each exit brings another listing that needs to meet the market, which is code for cut faster. Number 3, Northport. A market projecting below about $405,000 without a single loud headline. How does a downturn hide in daylight? Northport does it by moving in inches, not cliffs. Values chipped away between May and August 2025, roughly 13 grand gone, then kept sliding. The projection now points under that approximately $405,000 line by August 2026. Quiet on the surface, but the numbers are not quiet. Here's the setup. Northport boomed because it looked like Sarasota's affordable cousin. Same sunshine, fewer zeros. Builders saw the spread and ramped supply. Lots were snapped up. Crews poured slabs. The pipeline grew as if demand would stay bottomless. It didn't. Rates stayed high and squeezed the exact buyers who made Northport pop. As that affordability gap narrowed, the premium for driving a bit farther lost its edge. Demand thinned. The result is a slow bleed, not a headline-grabbing crash. You can see it in the cadence of pricing. 3-month decline stack on 1-year softness. Sellers adjust with concessions because price alone doesn't close the gap. You get closing cost credits, small rate buydowns, and inspection fixes baked into the deal. On paper, the comp looks decent. On the HUD, it's discounted. Here's the catch. Buyers are hitting debt-to-income ceilings. Even small price cuts barely dent the monthly when the interest rate stays elevated. That's the math. A $5,000 trim looks generous until you run the payment and realize it moves the needle less than a gym membership. Example time. In 2021, a buyer qualifying at 30% DT, I could stretch into a better house with the same income. Today, that same buyer sits near 39% at current rates. Pre-approval shrinks. What they could bid back then is not what they can bid now. The house didn't change. The financing did. Data backs the vibe. The share of listings with cuts sits above the 2022 to 2023 baseline. Not a blip, an elevated pattern. The scoring models that put more weight on price cut prevalence and average cut size are flagging stress because that's where today's pressure shows up first. As inventory accumulates, the next wave of reductions hits sooner. Sellers who waited through 1 quiet month don't wait through 2. Each new comp nudges the next list lower, and the cycle speeds up. It's like a thermostat that overshoots. Once the room cools, the vents don't just stop. They keep pushing until the target is met. Number 4. Deltona. When even the affordable inland option needs price cuts, you know the pressure is real. Deltona was supposed to be the safe bet, the budget backdoor into Central Florida. But the discount isn't hype. It's showing up in the listing histories and the monthly math. Here's the setup. Deltona rode Orlando's growth as the commuter alternative. About 30 miles north, you traded time on I-4 for a lower mortgage. That arbitrage worked when gas was cheaper, insurance calmer, and rates let you stretch. The minute any of those tilt the wrong way, the savings erode faster than you think. Now for the tension. Long commutes meet higher premiums, and wages don't sprint. You stack a longer drive on top of a rate that adds hundreds to the payment, and suddenly the deal looks like you financed a second car. That's why listings are getting sticky. In August 2025, average home values hovered near $330,000, down about 6 grand since May. Not a cliff, but a steady loss that hits real households. The detail is in the rhythm of the market. Listings sit. Then they relist lower to reset attention. A third week passes and the notes change from price to sell to bring offers. You see small reductions designed to trigger new alerts, then deeper cuts when that doesn't move bodies through the door. Traffic bumps on the first weekend after a cut, then fades again. Here's the catch. Inland buyers have thinner cash cushions. Rate sensitivity runs hotter because every extra $50 a month matters. You can't glue a budget together with vibes, so concessions creep in. Closing credits, small rate buydowns. Because price alone doesn't cure the payment shock. It's not that people don't want the house, they can't clear underwriting comfortably. Take the classic trade-off. You accept a 20-minute longer commute to save on housing. But with higher gas, rising insurance, and the current mortgage rate, the total monthly outlay cancels the benefit. It's like buying a cheaper gym membership across town and spending more on gas than you saved on dues. The math embarrasses the plan. Data ties it together. Projections call for a slight minus 0.2% dip over the next year, which sounds tiny until you layer it on an August where 29% of listings cut price. That's nearly 1 in 3 sellers blinking, exactly where stress shows first in mid-priced homes. Larger average reductions follow as patience thins. Investors feel it too. Rental carry costs are up, so landlords either eat the negative cash flow or sell into a softer tape. Some list high and discover the market doesn't care. They discount or they sit. Either choice drags values. Number 5, Sebastian. Sebastian rarely makes headlines, which is exactly why the numbers matter. Quiet markets don't ring alarms. They just shave off value until everyone looks up and asks when it happened. As of August 2025, average value sits around $362,000, down about $8,000 since May, and the last year already erased roughly $22,459. Let that sink in. Even with a tiny projected 0.5% bounce over the next year, the tape says softness, not strength. Here's the setup. Smaller market, fewer listings, limited turnover. That should mean stability until sellers start trimming to chase thin demand. One cut triggers a second, a neighbor follows. In a place this small, the feedback loop is brutal. You don't need a flood of inventory to move prices. You need a handful of motivated owners and a couple of weeks with weak traffic. But here's the catch. Less media noise means slower response. Sellers anchor to 2022 pricing like it's still the floor. They test a number, wait out a few dead open houses, then admit the market won't meet them there. Anchoring drags the process out, which makes the eventual cuts bigger. Time on market becomes the tax for ignoring the shift. The detail is in the sequence. You see incremental trims, 2% this month, another 3% next month. It never looks scary on a single update. But stack those adjustments and you're quietly taking $10,000, $15,000 off by quarter's end. That drip feels manageable until the payment math still doesn't work and buyers ask for more. In thin markets, a few big cuts reset comps for the whole neighborhood. One aggressive seller becomes the reference point for appraisers, and suddenly your firm asking price is a fantasy. It's like a thermostat in a small room. The slightest dial change shifts the whole temperature fast. Take the example everyone underestimates. A discounted waterfront listing. It lands $20,000 under expectations after 6 weeks of crickets. The appraisal on the next sale now leans conservative because the comp exists, even if that house had quirks. The block pays for one motivated seller's decision, and buyers know it. Track the week-over-week listing revisions, not just the median. Watch median versus mean diverge. When a few large reductions pull the mean down faster than the median, you're seeing stress concentrate in pricier segments. That's a leading tell that average deal terms are looser than the headline suggests. Buyers smell leverage and start asking for credits, rate buy-downs, and inspection givebacks. Sellers who wouldn't budge on price end up paying the bill on the back end anyway. Different line item, same haircut. Number 6, Homosassa Springs. When list price bravado meets weeks of silence, you get Homosassa Springs right now. Sellers come in hot, the inbox stays cold, and the only thing moving is the expiration timer on their listings. It feels bold, then it feels awkward, then it gets discounted. During the pandemic, retirees and remote workers stampeded in for value. Smaller mortgages, slower pace, close enough to the Gulf without paying the premium. That story worked until the bill showed up in places nobody likes to read. Insurance renewals, service calls, and maintenance that doesn't care about your spreadsheet. The cheap coastal life pitch got asterisks. But here's the catch. Insurance spikes and higher service costs smash the savings narrative. You keep the same square footage and suddenly the fixed costs jump like your streaming bundle after the free trial. Monthly outlays rise, buyers flinch, and the market starts negotiating against itself. The tell is right there in the reductions. Double-digit price cut activity is not a vibe, it's capitulation. In August, 27% of listings took a cut, and the average home value slid to about $275,000 from roughly $281,000 in May. The one-year drop sits near $13,754. Let that sink in. Sellers aren't flexing, they're chasing. Cash used to set the tone here. Fast closings, clean terms. When fewer cash buyers show up, the whole game shifts to financing. That means rate buydowns, points, and credits start steering the contract more than the sticker price. If you're not writing a check, you're writing concessions. A common play right now, a seller stays firm for 3 quiet weekends, then offers a 2-to-1 buydown and closing cost credits just to get to underwriting. The list stays pretty, but the effective price comes down, and the payment math finally clears the buyer's pre-approval. The comp later reads strong while the net tells the truth. This is where the data weighting matters. Average cut size carries heavy signal because it reflects patience running out, not just marketing tweaks. Small trims are noise. Big, repeated trims are stress. Homosassa Springs is throwing the latter. And that's why the modest 0.9% upside projection into next year doesn't feel bullish on the ground. Once concessions normalize, buyers simply expect them. Agents build credits into offers like line items on a grocery list. Sellers preempt the dance and list lower to avoid 3 rounds of public cuts. That's how you move from reactive discounts to proactive pricing, which resets comps faster than anyone likes. Mini payoff. Homosassa Springs crossed from value play to value trap for recent buyers who needed appreciation to bail them out. Discounts aren't a perk. They're a requirement to get deals done. But here's the catch. Florida's coasts don't move in one direction. Number 7, Fort Lauderdale. High-end markets usually resist cuts until they don't. Fort Lauderdale wore the luxury armor for years, then the seams started to show. The glossy tower photos still slap, but the negotiation lives in the fine print and the second price change. Here's the thing. Fort Lauderdale pulled in affluent buyers riding Miami spillover. Easy jet access, marinas, waterfront stock that felt rare. Developers leaned into amenity wars, valet, concierge, rooftop everything. Because demand looked endless. It worked. Right up until money got more expensive and the risk column got longer. But here's the catch. Jumbo loan rates set a higher hurdle. Flood maps and rising insurance premiums make the carrying cost feel like a second mortgage. And if you've been on a condo board email thread, you know HOA fees don't go down. They recalibrate. That combo nudges even confident buyers to stall, ask for more info, or just go rent the same view for half the headache. You can see it in the tempo above the median. Days on market stretch. Trophy listings test aspirational numbers, then quietly trim after 2 or 3 empty weekends. Price discovery isn't loud, it's awkward. A broker tour gets polite nods. The next update swaps exclusive for motivated. Luxury corrections start like that. Slow, polite, invisible to anyone just skimming the medians. Then 1 or 2 flagship drops reset the mood. The anchor comps move and everyone else has to follow or sit. It's like a yacht parade that suddenly hits a no-wake zone. Everything behind it slows whether they wanted to or not. Case in point from a recent deal. A waterfront condo took a 6% cut and then threw in a credit covering 1 full year of HOA fees. That's not theater. That's how you bridge the monthly shock without detonating the headline number. The sticker still looks proud. The net tells the real story. Track the split. In the luxury tier, the share of price cuts pops faster than in entry-level segments where inventory is thin and FHA buyers still chase. It's the higher end flashing more reductions, larger concessions, and longer marketing times. That's the tier where buyers can afford to wait, and they are. International demand softens at the margin as currency math and travel friction bite. Domestic cash hasn't vanished. It's just pickier. People with options audition properties now. They walk from special assessments, line item the reserves, and ask for inspection credits like it's a sport. Mini payoff. Fort Lauderdale isn't crashing, but in select luxury pockets, the leverage flipped. Sellers court buyers, not the other way around, and the best deals hide behind those tasteful lobby shots. Up the coast, you'll see the same tempo, but the buyer profile shifts and the playbook changes with it. Number 8, West Palm Beach. Sticker prices look steady. The real discount is buried in the contract. West Palm Beach looks fine at a glance because the median home price hasn't face-planted. That's branding at work. Waterfront glow, downtown amenities, restaurants that print vibes. The headline holds because sellers defend it, and buyers don't see the haircut until they sit down with the lender. Here's the thing. The city's brand props up top-line medians. You've got the Brightline buzz, polished retail, golf and pool brochures, and that Palm Beach halo a bridge away. Those optics keep listings ambitious and keep the median from wobbling. But here's the catch. To actually close, Sellers are dealing behind the scenes. To get deals over the finish line, sellers are throwing rate buydowns, closing credits, and post-inspection repair money into the mix. It's not loud. It's baked into the offer and the addenda, where only the people at the table see it. Buyers care about the payment, not the headline. Sellers care about face value, not the net. So both sides game the monthly. Builders lean even harder into it. Instead of blasting a $20,000 price drop on a billboard, they whisper, "We'll cover $12,000 in closing costs, buy your rate down for 2 years, and toss in quartz and an appliance package." Same effective discount, prettier comps. You tour a model dripping upgrades and think you won, but the spreadsheet is doing the heavy lifting. Nominal prices mask effective prices. That's the whole trick. Comps lag because an appraiser might adjust for concessions, but the neighborhood group text only sees the sold at ask flex. It's like ordering the prefix because it looks fancy, then noticing the service fee quietly ate your dessert. The real number lives on the settlement statement. Run a simple example. A seller offers a $10,000 credit paired with a 2-to-1 buydown. Year 1, your rate drops 2 points. Year 2, 1 point. Your payment dips enough to equal a quiet 3 to 4% haircut without touching the sticker. On paper, the comp stays strong. In your bank account, it's cheaper by a car payment. You can spot it in the list-to-close spread widening, while concession prevalence climbs in both new builds and resales. More deals show a gap between the ask and the net, even when the recorded price looks proud. Appraisers note concessions and adjust, but the median still photographs well for the monthly stat post. So, mini payoff. West Palm's resilience is part optics, part incentives. The discounts exist, they're just disguised as help. Speaking of optics, Miami's numbers look green, but read the fine print. Number 9, Miami. A projected plus 1.5% looks bullish. So why are sellers still negotiating like it's clearance season? Because the headline is doing PR while the offers tell the truth. You see the green arrow and think momentum. The counteroffer says bring credits. Here's the thing. Miami's global demand props up the medians. Luxury inflows keep writing large checks. Limited land keeps the supply tight in the zips everyone wants to flex on Instagram. That cocktail supports the glossy number you see on the chart and makes the market look invincible from 30,000 feet. But here's the catch. Affordability for locals is wrecked. Rate-sensitive tiers are taking the hit first, and they make up the bulk of actual shoppers. When your payment jumps by a car note, you're not bidding up. You're backing out. That's where the cooling shows up. Not in the penthouse, in the townhouse. Lower and mid-tier listings are flashing the signal. Rising shares of price cuts. Longer waits between showings. You scroll the change histories and it's reduction, credit. Meanwhile, Lux pulls the median up with a handful of big-ticket closes that look like a win on paper, but don't reflect the wider market. This is bifurcation. The ultra-wealthy set comps in a few zip codes, and regular buyers retreat because they can't clear the monthly. Same skyline, 2 totally different realities. One cohort swaps units like trading cards, the other is emailing their lender to rerun numbers after every Fed headline. Example time. A mid-tier townhouse trims 4% after 5 slow weeks, then tosses in closing costs to seal the deal. On the same weekend, a penthouse sets a record and floods your feed. Both are true, but only one matches the experience of most buyers trying to get a key. Contrast the price cut share by band, and you see the bruise. Entry and mid-move first with more reductions. The top keeps posting strong prints. Averages hide the pain because a few 7-figure closings can mask a sea of tiny capitulations. It's like a luxury steakhouse hiding a Tuesday discount on the bar menu. Technically the same restaurant, totally different bill. Now add rental softness in select submarkets. Rents flatten, vacancies tick up, and accidental landlords who expected easy carry list their condos and deal fast. They're not sentimental, they're spreadsheet driven. That adds more inventory exactly where the buyer pool is the most rate sensitive. Mini payoff. Miami isn't immune. It's just better at hiding the bruise under designer makeup. The projected plus 1.5% reads like strength, but the concessions and cuts tell you where the leverage sits. Finally, a big metro where the shift shows up in plain sight. Number 10, Tampa. Tampa's got the 1-2 punch. More cuts and longer waits. It's not subtle anymore. You can scroll the listing histories and watch the patience drain out of the market in real time. Here's the setup. Massive in-migration juiced pricing. People poured in, builders sprinted, and sellers got used to multiple offers by lunch. Then the music slowed. Rate shock hit. The easy wins dried up, and the tempo flipped from bidding wars to call for feedback. But here's the catch. Employers settled into hybrid. That spreads demand across the metro and softens urgency near office cores. With more choice and less FOMO, buyers got choosy. They tour more, nitpick more, and walk if the monthly feels heavy. When the crowd stops sprinting, price discovery starts. Detail time. We're talking double-digit price cut activity across active listings, larger average reductions than last year, and days on market marching upward. Not a cliff, a staircase. You'll see the first trim to spark traffic, then a deeper cut when week 3 is still crickets. DOM creeps from 20s to 40s to, is this thing haunted? Offers arrive with repair lists like mini novels. Tampa's the cycle on display. Peak, plateau, then discovery by reduction. Sellers test last year's high. Buyers counter with present tense math. Each round gets closer to the real clearing price and the gap gets paid in credits, buy downs, or both. It's not drama, it's mechanics. Example you're seeing in the burbs right now, a $500,000 listing cites 45 days, drops to $470,000, and throws in carpet and roof credits to keep the appraiser relaxed. On paper, it looks like a tidy 10-point haircut. In the net, it's more once you add the concessions. No fireworks, just gravity. The study lens matters. Heavier weight goes to short-term decline and the share of price cut listings because that's where stress shows up first. Tampa's flashing both. That's the tell you respect if you care about timing. Last quarter's comp won't save you when today's price change history is read all the way down. Here's how it builds. As those repriced deals close, appraisals lock in the new reality. Future listings launch lower to avoid the public walk of shame. Agents whisper, price to sell, and actually mean it. One comp at $470,000 becomes 2 at $468,000. Suddenly, $500,000 is a memory, not a target. That's it for today. Like the video, subscribe to the channel, and stay tuned for more updates you won't want to miss.